All right, I'm hoping this finally works. Oh, yay. All right, hold on, y'all. I think it's about to happen. 6 participants. Do I? 1, 2, 3, 4, 5, 6. That's more than 5. All right.
All right.
Thank you, everyone. All right, I'm gonna see if my friend Shannon can get in. For everyone who is on the call, thank you for hanging in there. Hopefully this is about to work. Yes. All right, I'm getting dings. I don't think you guys can hear them, but I'm getting dings that people are coming in. And so on the right-hand side, there should be a list with names. Can you all see that? There should be, had chat set up before. Oh, this is great. All right, people are dinging. There's a little chat button on the right-hand side. That's kind of what I imagined we'd use to submit questions. I don't have anyone muted, so I think when you start talking, it'll pop up on people's screens for those who are in video. I don't know if we're gonna have a large enough group to need to mute everybody. I can mute you on my end, so if like your dog starts barking, like I might try to mute you. And then you can unmute yourself. Obviously without having any idea how to do this, because we've never done it before, we're just kind of flying by the seat of our pants, so I hope that's okay.
Yes.
Thank you for being flexible so far. I'm hoping, okay. Shannon says she's here, good. All right, so I think that maybe we got past the super technical issues. Great, all right. Let me update the Facebook group. You're on.
Great.
Log into the meeting at your leisure. Boom.
Oh,
Okay.
these are always so fun. I've been a host of a go-to meeting when your menu totally changes and then you're like, oh my God, what am I doing?
Yes, yes. So this is going to be a little bit different. I know some people I think are muted. Some people are planning on talking, not planning on talking. Some people are just planning on listening. So I will say that I don't have anything prepared. Like I don't have a slide deck to go through. The intention of this meeting was to be a roundtable discussion. So for those of you who have seen those in the past, we typically have people submit questions into like a little container, and then we draw the questions out and read them and answer them, you know, regardless of topic. You know, I think that this, you know, the topic here is the stock market, but I kind of imagine the format being similar. So if you can either, I mean, I think with a small enough group, thinking that maybe if we're under 15 or 20 people, it can probably be where if you have a question, you can just, you know, introduce yourself. You know, this is Sarah. I have a question for the group. This is my question. And then, you know, we'll try to make sure everyone gets a chance to answer the question, follow up on the question, to share their thoughts. And then we'll kind of go down that route for as long as we can, and just hopefully it's not too cumbersome. I think we'll just have to, and again, see how it goes because we're flying by the seat of our pants. In the alternative, if you can use the chat box to submit a question, that might be easier in some ways, or if you could use the chat box to submit an answer. I'm trying to keep an eye on all of these things at the same time. Again, not have a ton of experience leading virtual meetings, just be patient with me, please. And we'll see how it goes. I have like a couple like other slide decks, some charts and things that I like from the last presentation that I put together from last month and the month before, or what I think are interesting bits of information that I can share via my screen. But I mean, this is kind of meant to be y'all's time to ask the questions and maybe especially like share the concerns or the thoughts that you have going forward, maybe the strategies that you have going forward, for the other people in the group who are really trying to sort out, this whole thing that's happening with the stock market over the last really kind of 3 weeks, really since the date of our last Austin Women's Investing Group meeting, which if y'all were there, we talked about this, we took some polls, and we kind of ended up that Monday, this being the start of this kind of official bear market. So I think maybe to start, I do have a question already in the group chat. So is it okay with everyone if we start there?
Yes.
And we'll just kind of keep going with it. I'm seeing some nods, I'm getting some yeses, so I'm just gonna go for it. Okay, so Ellie to everyone asks, I have a question about gold. I have some investments in gold and I kind of want to get out of them. I don't understand the value of gold except for the 1700s. And so that's, a pretty good topic to start off with, because I think with anytime you're talking about a crisis or a decline in the stock market, the topic of gold comes up. So I would love to know, I don't have a ton of experience investing in gold. I get the general gist of the story. But I wonder if there's anyone in the group who has some advice for Ellie about whether to hold it, whether to, sell it, or kind of what to do. I'm happy to just talk about gold if y'all want to listen to me talk about gold. I mean, Ellie, I think that kind of I was preface this with saying that, I approach all of my investing from, oh, hold on. Got some people that maybe were, Ellie, are you just joining now, even though you submitted your question before? We're on your question about gold, if you can hear me. The question about gold is, what is it good for? I think, in a crisis, what people come back to with gold is this idea that it's worth something, right? That we've all agreed as humans that we're going to value this metal in some way. And that in a worst case scenario of your assets losing all of their value or your currency losing all of its value, at least you have this thing. I think the Warren Buffett perspective on gold, I think, is pretty well known. Warren Buffett's perspective that gold is old and dead and has no capacity for growing or changing or adapting. It doesn't pay a dividend. It doesn't have any ideas. And that, to compare gold to stocks, you're comparing two totally different things, right? Because stocks are ownership in companies, and those companies have the ability to innovate and grow, generate profits and generate dividends and increase in value over time. So I can see both perspectives. I'm always drawn to the Warren Buffett perspective of gold, especially as a long-term investment. And anytime you're really talking about kind of shorter term speculation type of timelines, I become less interested in things. But this is my personal bias. So if there's anyone out there who wants to kind of chime in, that would be awesome.
Sarah, I don't have anything to chime in, but I did wonder if wanted to kind of can you hear me?
Can you turn it up a little bit? I can barely hear you, Lori. I can see that you're trying to talk, and I can recognize your voice, but I can hear you.
Okay, I have to figure out how to turn it up.
Oh, there we go. Yes. Hi.
Okay, that better?
Yes.
Okay. I was wondering about doing the whole level set of don't panic and run out and sell things now, stay the course, and then sort of take a deep breath and think, okay, what are you going to do next? Because some people's first instinct might be, you know, what do I have to get out of right now, as opposed to holding on to things and basically waiting. And then Anna had a question about what can I do? I have cash. Should I do something with it? What's the best thing for me to do? So I thought maybe for people who, you know, might not have experienced a big downturn like this before while they're actually holding stock, maybe do that kind of level set discussion first and then talk about like, okay, what should we do next? P.S. What stock should we buy? Anyway, that's what I was going to put forward.
Yeah, perfect. I think that is a really great idea. So if we kind of, you want to start with, you know, you are a fairly experienced investor. Kind of what are your thoughts on this level setting? Has the stock market expectations, or are your expectations? Were you, Lori, were you ready for this downturn, or has it been something?
I was, so everybody was saying there should be a correction coming up. So you could say this is the correction, but I think this is more everybody thinking about the coronavirus, and well, for me, it's realizing that supply lines might be slowing down because people are sick or they're not coming into work, and so deliveries might be delayed, and then that just has a trickle effect in the whole economy. So to me, that's where some of the reduction in stock would come. But I think the big drops that we're seeing are people just kind of like panicking and thinking, oh, it's hunker down mode. For example, people are like getting bottled water from the grocery store, and it's like, well, it's not really that kind of an emergency, but that's like people's default action. And so I think that's why the market is down right now. So what to do is just wait it out, because eventually the virus will work its way through the system, people will come back to work, everything will start churning again. But to me, stay the course and make sure you have plenty of cash around before deciding you want to spend it. Make sure I would say you have enough cash for at least 3-4 months, maybe longer, I don't know. But then I actually was thinking what to buy. And I was talking with my brother, who's a big investor too, and he was telling me, he's like, I already bought Amazon. I bought 3 Amazon stocks. And he's like, I'm thinking Warren Buffett, you know, for Berkshire Hathaway. And I was thinking, yes. So he has already been out there looking around to see what he can buy that normally is out of reach because it's so expensive. And so that was the advice I wanted as I lay a finger aside of my nose for me. But yeah, first it's like cash. How much cash do you have? Because the economy is going to be down. We're probably are going to be staying home for a while, which might make dealing with other people more difficult. But eventually it will swing back up. That's my two cents on it.
Yeah, that's great. Does anyone else have anything to add?
Can you guys hear me?
Yes. Who is this?
This is Anna.
Hey, Anna.
So I met with my financial advisor, not this Friday, but the Friday right before this terrible past week. And we were starting to talk about reallocation and at what point should we reallocate, you know, from the bonds to the international, with the drop in the market, everything didn't look like it was, allocated in the percentages that normally, a financial advisor would kind of recommend, in the different pockets of aggressive, moderate or whatever. So is it, when you say hunker down, and this is more of the defensive side of investing, is it just kind of like waiting on the volatility? And at what point can we recognize that, all right, it's not so volatile anymore?
Yeah, so Anna, so in the discussion with your financial advisor, you were talking about potentially moving out of something safer into something like stocks, or the opposite direction.
Right. I had, surprisingly, I had a bunch in bonds.
Yeah.
And so, I took money out of bonds. I sold it that day and put it into more of the blue chip.
Yeah.
And so, but that, according to last week, that wasn't a great move. But yeah, so we started doing that, and now, like Lori said, I'm kind of just, I just kind of halted everything at this point.
Yeah. I mean, I think that question of asset allocation is really the place to start for most people. If now is the time where people are looking very closely at their portfolios, take a look at that percentage of stocks versus bonds. I think one of the common misconceptions that people come into investing with is this idea that you're all in or you're all out, right? When realistically, that's not how most people invest. Most people have this diversified portfolio. The reason you have bonds in your portfolio is that they're not stocks, and they're much more stable, and the price doesn't bounce around as much during times like this. And the reason that you own stocks is because you expect them to be worth a lot more in the future, right? Without the timing of that future being known or really being knowable. So Anna, it sounds like you've kind of had this experience where you did what you were advised to do and what you were probably supposed to do, which is like, I took some money out of bonds, I put it into stocks, and then the stocks fell, right?
Yes.
Which feels terrible, right? But I mean, part of this group, part of my job, which I failed to mention before, and that by day I'm an investment advisor, so I advise people on these questions all the time. I'm not here as an advisor right now. None of this is individualized investing advice. I'm recording this, so now I know that I said that to everybody. But the reason you own stocks or buy stocks isn't because you think they're going to go up tomorrow or a month from now or even a year from now, or maybe a couple of years from now, depending on what happens, but because you expect them to be worth a lot more 10 years from now or 20 years from now. And if we kind of come back to this expectation that, okay, over the long run, historically, looking back decades and even centuries, the stock market tends to double every 7 to 10 years. Not on the button, and it's not guaranteed, but it's an expectation. I think it allows us to really zoom out from this overload of what happened last week, right? And it is super painful to be getting this pricing information from the stock market every second of the trading day, right? And it's whipsawing, and it's up, and it's down, and it's crazy town. But your stocks are there for the long run. Right?
So I guess that's my question, just kind of summarize it, is kind of, should we just throw allocation out the door at this point? Because as stocks keep falling, that allocation will keep changing. And so, and that was my follow-up question is, it's easier to allocate when stocks are a little bit more stable and And is there some kind of indicator that we can look at to be like, all right, so now I can start kind of reallocating again, instead of just doing what I did where I was trying to reallocate and then it didn't even really help any because stocks kept falling and so my bonds still stayed high.
Yeah. That's a really, I mean, I think that's a really good question. On the question of the indicator, and I'd be, I'm interested to know what other people have heard about. My personal, very strong opinion, which I think is based in lots of research and education, is that there's no indicator that's going to tell you what the right time is. The stock market's going to keep falling until it stops falling, and then it's going to start going up until it starts falling again. And that, and that's what makes it so maddening, right? And that's, but that's also, that uncertainty is why you expect to get the higher rates of return over time. Like a lot of people have been talking about 2008, 2009, and now it turns out that, maybe rightfully so, because the stock market just kept falling until March 9th, 2009, when that day it hit its low and then it kind of pinged and never reached those levels again. And no one knows what was special about March 9th, 2009. There wasn't like a big announcement. There wasn't like anything that happened. It was just the day that buyers started being more buyers in the market than sellers. So I think the asset allocation problem, it feels like, okay, if you're trying to get to 60-40, 60% stocks, 40% bonds, whatever it is, and you took cash out of bonds and you put it into stocks, and then the stock market fell, and now you're back in the position where you, again, because the market fell so fast, now you're faced with a new decision of, do I sell more bonds and buy more stocks in order to bring my asset allocation up? I would kind of say, especially if you're uncomfortable with that, maybe you do just pat yourself on the back for rebalancing last week or the week before and give it a few months or a few quarters or a year and see what happens. Because, maybe it is, it can feel to people like flushing money down the toilet, right? Like I put money in and then it falls, and it's like this never-ending perpetual cycle, but it does end at some point. I just don't think that you should bank on having any idea when it's going to stop. It could be over, right? Maybe it stopped on Thursday, and Friday was the first ping up in a new bull market, right? Or maybe this gets a lot worse from here.
Right. So I guess that leads me to my next question. There's the defensive side, then obviously there's the offensive side to investing. So to me, it's safer to invest outside the market right now. But every group or every investing forum that I'm looking around, the vultures are out and they quote Warren Buffett, be greedy when others are fearful. And so I'm just kind of wondering what your thoughts are on that, as far as like the buying in with cash at this point.
Yeah, I mean, I think that, again, going back to your asset allocation.
Just a minute, Sarah.
Oh, yeah.
I just wanted to say, if you're not speaking, go ahead and mute your microphone or your phone if you're on the phone. Otherwise, we pick up background noise, and it's hard to hear.
I might be able to mute I don't know. Should I mute everybody? I think I can mute people on my end.
If you're talking, I would mute everybody except except for Anna. Yeah, since you're talking to her.
Okay. And then when you have a question, you can unmute everybody. And
maybe when you're at a pause after answering a question.
Okay, thank you.
But I don't think you want to unmute everybody. I think if you mute everybody, they can unmute themselves.
Okay.
That's my guess.
Hopefully that's true. Okay, cool. All right, and Lori, I don't have you muted either, but it looks like now I have everybody else muted. Thanks everyone for hanging in there here. Okay, what was I about to talk about? Oh, investing, like what do you do with your cash, right? Like the idea of safety and risk is an important one. I would say that every investor has to figure out what their expected rate of return going forward is and what their required rate of return is going forward. Most people who are not, and it depends on your situation, most people need their money to grow at a certain rate in order to give themselves enough over a long retirement, right? Or lack of a better word, a long life. And so most people need exposure to high growth asset classes, of which stocks are the most famous, I guess. There are probably other ones. I personally think that over the long run, a lot of people end up playing it safe, and it comes back to bite them in the long run, because maybe they don't have enough money to have the type of retirement that they want over the long run. So by playing it safe, you're actually taking on a lot of risk, right? The risk that maybe you run out of money in retirement, or you don't have enough to pay for the things that happen, 20, 30 years into retirement. But I don't know, for you, I don't know what that answer is. I think, as an advisor, it's my job to figure out what that answer is for my clients. And for the people here, I think it's our job to figure out what that number is. Do we have enough? If the answer is maybe not, or no, then you need to figure out how to grow it fast enough to get it to where it is large enough to allow you to have a comfortable retirement. And this is the time when prices are relatively low. Now's the time where your expected return is actually higher, because prices are low. It's like buying, like a house in Austin, right? Like I think we all wish we could go back in time and buy a house or buy more houses when prices were really super low. But, during 2008, 2009, which is kind of the last time that happened, a lot of people were scared, right? And didn't take the opportunity when it came up. So I guess that's kind of a way of saying, to a really, really good question, Anna, like a really good question, like what should we be doing with cash? I always think that the answer is kind of given to you by a really careful consideration of, do I have enough now, and do I need to just keep what I have, which is one circumstance, or do I not have enough and I need it to grow? In which case there aren't that many asset classes that you can expect to have as high a rate of return over a long period of time as stocks. I'm going to stop talking for a second, and I don't know, maybe unmute everybody to see. Okay, now everybody's unmuted. So if you want to chime in, or Anna, if you want to follow up on your question, I think everyone is unmuted.
I could follow up, but if anybody else has a question, please go ahead.
Yeah, go ahead.
I have a question. What about like taking your money and putting it in a CD? Have you seen the CD rates drop any? Or, CDs obviously pay more than your normal savings account. But I guess you'd need to know how long you want to put your money in for the CD. Kind of,
yeah,
the same concept as knowing when to buy into the stock market again.
Yeah.
Or something, but it helps grow your money a little bit.
I think the rate. Does anyone know CD rates right now? I think that CD rates are so low that the only reason that you would get one is because it's absolutely money that you cannot lose. The Federal Reserve just lowered interest rates, which means short-term CD rates will definitely come down if they haven't already. And they're expected to cut rates again going forward. That's what the Federal Reserve does during times of financial stress. So I would say that CD rates are on their way to maybe as close to zero as they were 5 years ago. And it's, it's an option for money that needs to be super safe. It might be better than what you can get in saving, but I think if you do the math on it, we're probably talking about the difference between like a handful of dollars. Unfortunately, right? Like there's just, but in the case where you have $100,000 and you invest it in a CD and you get 0.5%, that could be better than the negative 10% or the negative 20% that you would get in the stock market from here on out. So like on a relative basis, it might be worth it to look at it. I wouldn't call it an investment. I would call it, sorry, Dora, I'm trying to unmute you. I wouldn't call it an investment. I'd call it like, this is my cash, right? And people need cash, right? Like, I don't know if anyone on this call would be talking about anyone going to 0% cash right now, right? Let's take all your cash and just invest it all right now, right? And roll the dice. So I think the CD question, again, I wouldn't consider it an investment because maybe technically it will grow, but I don't know if it qualifies as growing enough to make a giant difference in your standard of living 30 years from now, right? Or 20 years from now.
Right.
It's a really good question. I think I'm getting of unmuting everybody and muting everyone at the same time. So, Ellie said mute me. Okay. And Anna said I need it to grow. Oh, and Lori said CD rates are around 1.86. What's the term on that, Lori? Do you know how long? Sorry, I'm coming to try to unmute you. Do you know what the
That looks like it was around 1 year.
1 year.
And I just looked at bankrate.com really fast just to get a comparison.
Yeah.
So, I mean, they're better than they were during the 2008 crash, but yeah, they're not very good right now.
Okay.
That's actually better than I thought it was going to be for 1 year. I have to.
I know, me too.
I thought it was going to be like 0.25 or something, right? So it's still a thing.
Better than I thought, yeah.
Yeah. I mean, and with the CD, take the amount you're going to invest in the CD and multiply it by 1.86%. And those are the number of dollars that you'll get at the end of the year. So it's not going to be very many dollars, right?
Right.
But it's not going to be negative dollars either.
Yeah.
So again, it's like a relative decision. Again, I don't consider CDs like a traditional investment. I think
Sure.
It's like a where you hide your cash type of thing. If we're talking, where are we on the risk spectrum? Like, this is money I need to be safe, right? Like, oh, I'm going to invest my way to retirement by using CDs. Like, if you're starting with $5 million, it's probably not going to work. So,
yeah.
But that's just like and maybe if you are starting with 5 million, it still won't work. It's very tough math over the long run, but maybe okay for the short run.
Yeah.
Yeah.
I would say if you have the money sitting around, it kind of depends on what you were planning on doing with it before everything tanked. If you had it sitting around and you were thinking, I'm going to invest some in the stock market, I just don't know what yet. Now's a great time to do that. If you had it around and it's just in your bank account, it's going to stay there. It's not going to disappear. It's still true that mutual funds are good places to put money because they also, like the stock market, will be going down, but then they'll go back up. And if you're uncomfortable putting some money in the market right now because it's so low, that's kind of trepidatious doing that because we don't really know what's going to happen. We only know historically it goes up over a very long period of time. But you could make a bargain with yourself and say, okay, I'm going to take this part, like say, 20% of your money, and that's going to be my investment money, and I'm going to do something with that money, and I'm going to keep the rest here to be safe. And then maybe 3 months later, you revisit it and see, did it go up or down? So yeah, so you don't have to, like Sarah was saying earlier, you don't have to like be all in or be all out. Yeah, I still think if you have your money and that's your savings money, it would be better to park it in a mutual fund or something like that with a large company like Vanguard or Fidelity than to even do the CD, because their rates aren't really very high right now.
Okay. So can I follow up with what Lori and Sarah have been talking about? As far as the coronavirus, I guess in a way it's a little bit different that I feel, because usually if there's like a dip in the economy, our advice is, trying to boost it by getting people to go out and do things and buy things. But because of the social distancing, that's almost impossible to do. So it seems like it's impacting a lot of things. And I'm trying to figure out like what it's impacting the most, retail or some of these industries. But I think as a general, I feel like we should stick with the overall index funds versus kind of now really tailoring it to certain industries that the coronavirus is really impacting as far as investment goes.
Yeah, I mean, I think that, for most people, like if you're in the stock market, the best, easiest, cheapest, most straightforward place to start is with an index fund, right? And that, you will track the market. You'll go down when, the stock market, I'm using my air quotes if you can see, the S&P 500, this large basket of US stocks, when the prices of the S&P 500, your index fund is probably going to fall. And when it goes up, it's going to go up. And for most people, it's the most straightforward way to do this. So if it's the question of like, am I in the stock market or not in the stock market, the best and easiest way, maybe not the best way, the easiest way and the most straightforward way is like, I'm just going to buy an index fund and call it a day and not try to tie myself up in knots, figuring out what companies are going to fail and what companies are going to do really well. With what I've seen and read and heard over the last, it's really last week and, the week before, as we've gone into, recession mode where people are becoming more and more convinced that there's going to be a recession. When there is a recession, companies' earnings fall, right? Profits fall because people stop spending money. And that means sales at companies go down, right? Expenses don't come down as fast as the sales come down, so profits go down. And the stock market is directly tied to profits. There's a recession and the profits are going down, the stock market's going to go down. Like in anticipation of that happening. It's not necessarily happening right now. The stock market is now anticipating that happening. And one of the things that seems to be happening in the market with these whipsaw events, right, down 10%, up 10%, crazy town like last week, is investors are having a really difficult time, because it's really difficult, a really difficult time figuring out how far profits would or could fall. And to put it into context, I have I'm gonna share my screen for a second for those of you who are on video. Am I gonna share my screen? Maybe. Let's see if I can do that.
It looks like there's a share button down next to the chat button.
I know, but I didn't even have the thing up that I wanted to share, but I'm really gonna share this. Thanks, everybody. And it's something that I've shared before with the group. Share screen. Okay, can you all see my chart here, the relationship between price and earnings?
Yep.
Yes.
This is a chart I show all the time because I think it shows this relationship and what we're dealing with right now in my opinion. So we have the black line, which is the price of the S&P 500. And this chart goes all the way back to 1988. And then we have the red line that's showing earnings, right? Or profits. Earnings is another word for profits. And we see that profits go up and down. Like that's the business cycle. It's expansions and recessions. There's a financial crisis thrown in there for good measure. So as the red line is moving, the black line is moving. And obviously this black line is out of date now because this is from last month's Austin Women's Investing Group presentation. That black line has come down, really at times almost to that 2,400 number over on the right-hand side, if y'all can see that, in anticipation of that red line coming down. Over here on the left-hand side, you can see that the axis that's showing S&P 500 earnings. Just to put it into context for y'all, last year, 2019, S&P 500 earnings were 163, right? So over here, like on the, the 160 mark. In our red boxes over on the upper right-hand side, people were projecting that earnings would continue to grow in 2020 and then into 2021. And now everybody's recalculating that number. So if people say this is going to be an incredibly severe global depression, then their S&P 500 earnings estimate is going to be super low, right? Like, oh my gosh, do we go back to $100 or 110 or 120, which leads to a very catastrophic decline? Or if it's a good case scenario, do you say like, okay, earnings are definitely going to be impacted maybe 1 or 2 quarters, but then we're going to kind of figure this out, maybe not get back to normal, but get back to normal-ish, and earnings aren't going to be that low for 2020, and then they're going to grow again in 2021. Or, if you're really optimistic, you're like, oh, this is not going to have any impact at all, right? Which at this point is kind of crazy to say, right? but maybe someone out there is saying it. I don't think anyone's saying that. But this earnings estimate over here is what's driving the ups and downs on this black line. And we're not going to know until we know. And the other thing about the stock market being forward-looking and forecasting is that the stock market, the black line, will react to a better outlook. It'll react to that before the better thing happens, which is what makes this timing issue, Anna, going back to your original question, so difficult. The stock market will start going up before things actually start getting better, or before we can even perceive that they're getting better. That's not a guarantee, but it's how it's happened in the past. The stock market has usually kind of anticipated improving conditions before they actually happen. Which just makes it incredibly difficult to figure out like how far can it fall, because it's driven by people's forecasts of an unknown future.
But as far as the foreseeable future in earnings, given what's going on right now, is there the assumption that earnings are going to drop at this point?
Yeah, I think so. I think people are assuming that at the very least they don't get better, and that's like a best case scenario. And in a worst case scenario, we have a legitimate recession and a lot, and profits go down. If profits went down by 20%, let's say, sorry, I'm getting my calculator out, off of 163. So 163, we had a 20% decline in profits. That would be an earnings estimate of 130. Right? Which like on our little chart here gets us down pretty low, but maybe not that far off from where the price is right now.
Mm-hmm.
So it seems like that to me, that 2,400 level is the price where people are assuming there's a recession. It could certainly go lower, right? Certainly if you would get to the 2,200, the 2,000 range, those are the prices where investors have basically agreed that there's going to be a recession. And like, you know, maybe it's not a small recession. If numbers come in that make it seem like it won't be that severe, then you would expect the price to bounce back up. If numbers come in and people expect it to get a lot worse than that, then the stock market would go down. Right now, everybody's just guessing because we have no information. I will say though, like going back to Lori, like one of your questions about what to look at going forward. Adobe, the company Adobe, right? Adobe Acrobat and Documents and, you know, whatever their whole suite of products is. They just released their last quarter earnings report on Thursday or Friday. Maybe it was yesterday or the day before. And it was interesting because they were able to talk about, you know, what happened last quarter, which at this point, you know, nobody cares about. But they also provided some guidance going forward. I'm like, what are your customers saying? What are they doing? How do you expect Adobe, the company, how do you expect your revenue and your profits to be impacted? And if you go through the earnings report where the company is talking about this, I mean, I thought it was really interesting. Like from their perspective, they're like, yeah, we haven't really seen a drop off in sales because as people and companies are figuring out what products do they need to operate in the future with a remote workforce, with every company needing to solidify its digital strategy, what subscription do they need? Like they're gonna need Adobe, right? So it's one of those companies that like, yeah, like our business doesn't seem to be as impacted by this as say Carnival Cruise Lines, right? Mm-hmm. Any place where people gather in large numbers in person, where it's just like a totally different, you know, totally different analysis for those types of companies. And so I think the companies that come out of this stronger are going to be the ones that either are already in line or pivot really quickly to address the needs that we're all going to have in the future as we're dealing with this, right? Like Dora and I were just talking about remote work before you all joined the call. And I'm sure every person on this call is dealing with this in some way. How do I do my job from home, like away from people? I think that's going to be a big thing, a big trend that was already happening, but now is happening, like for real. And what does that look like when you start trying to think about the companies that you want to buy going forward? Some of those companies in the S&P 500 are going to do great, and some of them are going to die. They're just not going to make it through this because they're not the companies of the future. And that's going to probably be a messy process. Okay, I just unmuted everybody, so I'm sorry. I was hoping, here, Ellie, I'll mute you again if you wanted me to. But I would love, like on that note, to kind of hear what people are thinking about or talking about when it comes to, if you can imagine things 6 months from now, what might that look like? Or a year from now? Like, is it back to business as usual? None of this is even going to matter. Like, I underestimated how much this thing was going to spark. Like, I really did. I was like, oh, you know, SARS, like MERS, like, oh, we've had these epidemics in the past. And I wasn't ready for it to be like, holy cow, like this is a thing. But like, what does this look like 6 months from now or 12 months from now when we get out of it? I think that's a really interesting thing to think about.
I think you're right. I think, oh, sorry. I'll just say something, then whoever wants to talk next. That this will force companies to figure out how to work remotely. And so I think they're being more likely to do that, even if it's only part-time after this event goes by. And yeah, I did kind of want to brainstorm with people about what companies would be up and coming. And one thing that I've been wondering about is deliveries. if people will be leaning more towards deliveries now because they don't want to go into stores. So that would mean deliveries of groceries, buying more stuff from Amazon, any company that's a retail company that already has a really good e-commerce website, that type of thing seems like that's one thing I've been mulling over. It's like, are people more likely to want someone to show up on their porch who's a stranger who's been going to lots of porches, even though they don't have to see them?
Yeah.
Or would they still go out and shop because they just want to? There's a question from Ellie when you get a chance, Sarah. But anyway, that was what I was thinking. I haven't had any other brainstorms really.
But even speaking to that, I guess that just kind of is similar to the question that I had posed earlier, as far as like, it's fun to brainstorm thinking about which companies will pivot and do well based on what's happening right now. But in the end, we're just going to probably pick a S&P index fund, right? And so it's up to the managers to really decide that for us at this point.
I mean, if you're picking an S&P 500 index fund, then you're not picking anything special, right? You're just taking the market as it comes. If you're paying an advisor or a mutual fund manager to be more targeted, then I mean, you do have the option to be more targeted if you want to. It's certainly not a recommendation, right? You know, that either a person or, you know, that someone in the Awesome Women's Investing group, that their best option is to really think about this and analyze all the companies and analyze all the fund managers and spend a bunch of time to try to figure out what they think will happen in the future. But it might be right for some people. It might be kind of like an invest in what you know type of situation, like Lori was mentioning, you know, like Amazon has a pretty good e-commerce site. I don't know, they're all right? And people seem to like them, right? Like, is there the possibility that Amazon comes out of this stronger than what it came in? Like, I think a case could be made for that, right? There are probably a bunch of companies where the case could be made that even if it's just a small, either individual allocation to those companies, like here's my S&P 500 index fund, and then I own 3 shares of Amazon, right? You're tilting towards Amazon without it being 100% Amazon, or something like that. Like those are kind of combo platter strategies that I think even a regular investor who doesn't want to spend that much time on it could do. Like I have my S&P 500 index fund in Apple in some amount, 1%, 2%, whatever it is. But that something special, I think, has to be something that you believe in and can gut through these horrible times with, right? Because you might have been all about Apple when it was at 350. Are you still all about Apple when it's at 175? Like some people are like, yeah, I'm still in it, right? And it doesn't bother me. And some people are like, oh, I made a terrible mistake. This is horrible. Apple's going under, right? So like whatever those special things are, I think you have to really see the possibility of it happening in the future the way you're imagining it happen now. And you have to be able to take the additional risk that comes with it. Oh, Charlotte says eBay. And Ellie, thank you. Ellie says, I like these brainstorms. LaQuisha, hey, airlines are interesting. Who will survive? Will they get bailed out if they can't make it? The ban on international travel hurts some even more. Man, you're brave if you're thinking about airlines. That is a tough one for me. It's just tough to watch happening. One of the things, someone sent me a question about Boeing, right? Kind of along those lines, right? Like, well, the government would never let Boeing go under because they're a duopoly, right? And we need airplanes, and they're probably not like a national security concern. But what I reminded this person of is when The banks were bailed out in 2008, 2009. When the government comes in to backstop a company, they don't do it for free. The arrangement is like, hey, we'll put some money into this and we'll keep you alive, but we're not going to let the previous owners take profits out of the company for a very long time, right? The banks, the banks had to like prove to everybody that the government had been paid back and that they could be trusted to like increase their dividends or pay a dividend. And that was, so even though like some of those big banks didn't die during the financial crisis, just because they didn't die and survived, that didn't make them good investments for people. Does that make sense? Because the government is coming in and the government's going to say like, hey, we'll loan you $5 billion, but you're going to pay us the $5 billion back plus 10% on top of it. Plus we're going to keep a portion of the ownership, right? Like there are like strings attached to it. And so with something like the airlines, like if there was a bailout or with Boeing, I don't know if it's good for investors. It's probably good for the economy because you don't want those companies laying everybody off and going down in a pile of flames. But I don't know if it's good for investors. So that was kind of a sidebar and on something I was just thinking about the other day. Anna says, whoever makes toilet paper and hand sanitizer. Yep, you could go back to the basics, right? Like who's making all that stuff? That would be something that would be relatively stable. Health growing, Ellie asks. Do any of you have experience with like, I'm assuming you're talking about like telemedicine and things like that?
I do just a little bit. This is Peggy.
Yeah.
We're actually looking at how to provide telehealth for therapy, and there's a lot of stuff going on where they're talking to the Medicare, Medicaid about being able to free up to be able to provide services for people through telehealth. It's written into our licensing standards. I'm a PT, but also for a lot of the other disciplines too, kind of how that's going to be provided. And I think the biggest barrier at the moment is like, do providers cover that? So it's more back to the insurance restrictions. But there's certainly technology about how to make that happen, like apps and platforms and, you know, kind of going back to some of the stuff that was talked about earlier, like Adobe or doing different things from afar, you know, how to do the teleconferencing, even Ring Central, you know, like I might be able to provide sessions to patients through Ring Central where we're hooking up our audio and video together.
That's really interesting.
Zoom meeting, things like that.
Yeah. So can you explain a little more? That always seemed like something to me that was a really, really good idea. And I didn't understand why it was such a slow rollout. And I think you just mentioned what it was, but can you elaborate on that a little bit and how that might be changing?
Well, I don't know a ton from all the different disciplines, but I know in general, like anytime you see a patient, like for me, I'm doing home and community-based therapy. So I have to have the patient sign everything when I'm there. And so it's like this in-person thing. And so if you have something kind of virtual, kind of making sure you have all those pieces in place and the video stuff set up, and it has to be HIPAA compliant. And then it also depends on the payer sources. So if it's Medicare, Medicaid, that's a certain chunk of the healthcare dollar. But then if you're looking at all the different healthcare payer sources, you know, private insurance, for example, then they wouldn't, you're more restricted by the company, the insurer.
That's very interesting. But I can imagine a world where someone forces all of these people to get into a room and figure it out, right? Like
they better figure it out fast.
Yeah, right. I mean, but like
now they're having to do it in the moment, you know?
Right. I mean, like coming out of this, if everyone was like, okay, this needs to happen, this is a priority, right? And we're going to, I don't know, rewrite statutes or legislation or whatever it is, licensing requirements, or, you know, have some company figure out how to make everything HIPAA compliant, right? Like it seems like there must be a solution if you forced people to do it. And a lot of times, like something like this is what forces people to change, right? Like forces industries to change.
Yeah,
It's
I
certainly
have
a disruptor.
oh, this is LaQuisha. I have Cigna Insurance and they have Teladoc, which is a publicly traded company.
Yeah.
And yeah, I've used it before, and you can either just call in or video conference and you talk with a provider. And they'll send in your prescription where you need it. And I think it's a really good alternative right now since they're recommending everyone, like if it's a chronic condition that can be managed over the phone, to use more things like that instead of being seen.
Yeah. I think I have Oscar, and they have a phone call you can make and talk to a doctor. And I think I did that when my daughter got pink eye, and I like sent him a picture of her pink eye, and then he called in a prescription. I'm like, that seems way better than taking my pink eye kid to a waiting room with a bunch of other pink eye kids, right? And just getting the pink eye around. So I think that's very interesting. And yeah, Teladoc is a publicly traded company, right? So it's already out there. It's already doing things. I think I know at least one person who works for Teladoc. That's very interesting. And along those lines, Lori says companies that make support or that make medical supplies like needles, test kits, alcohol swabs. I mean, that's certainly a big one. I think coming out of this is, who are the companies who have the testing machines, right, to do these tests? Like, who can do it the fastest? Who can do it the cheapest? That I think is going to be something that comes out of this as well. I think that's really interesting. All right.
Another one, medical related, which is like one of my interests, is DNA testing and gene immunology type stuff. I don't know. It seems like that is rising. I don't think it would rise more because of this, but it does seem like money that was previously maybe not going to be put into the medical field might be now. Apparently, the head of the budget office, even this week, was arguing that they wanted to cut the CDC budget. And that'll probably be shot down right away now. So things that maybe previously were medical related but weren't doing very well perhaps would do better now. I don't know.
Yeah, I think that's really interesting too. Again, like trends that were there, right? So not something that just popped up out of nowhere, but something that might gain strength coming out of this. I love that idea. Dora said United Healthcare also has a Teladoc piece and has been promoting it heavy so far this year.
Oh, so previously Ellie was wondering if you had, basically, if you're a new investor, if you, Sarah, and a very experienced investor is going through this, what would you tell somebody who's going through it the first time, who's a beginning investor? And is there anything that you would maybe advise differently because you've already gone through this? Let's see. Basically, what advice would you do differently? What advice would you give to a younger investor experiencing this for the first time?
Oh man, that's a really good question. I mean, like most of you, and I'd love to hear everybody's experience. I'll just kind of go first and then definitely open it up to other people who would share. I worked for this hedge fund that was in the junk bond industry or the junk bond market in 2008, 2009, in the middle of the financial crisis. And I definitely didn't fully appreciate how flexible and resilient our system is. Like the US economy, the US markets, capitalism, all of these things like are built to withstand these shocks, right? And when it feels like things might go to zero, right? Like something might lose all of its value, that if you are not in just one company, if you are just in the stock market in general, that the system is set up to incentivize companies to create the goods and services that people will buy, right? And not every economy is like that. right? Not every stock market is the same. I think the US market is exceptional in that way. That companies will figure it out, right? We don't know things are gonna look like in 6 months, but if you kind of believe in that power of innovation and the system that we live in, you would expect some companies to thrive in whatever the next phase is. And I didn't appreciate that when I was younger. I thought I got really caught up in the day-to-day price swings that, during that time, the stock market fell 50% in 16 months, right? Which I don't know, we could be on pace to do that faster this time. But it felt like the end of the world to a lot of people. And I was in the financial system, so I think I especially thought it felt like the end of the world. And I was, how many years ago is that? I'm 40. That was 12 years ago. So what, I was in my late 20s? Like, if I could go back, I'd be like, Sarah, chill out. Just put it all in your IRA, put it in the stock market, and walk away for 30 years. And so, like, with every young person, that's kind of just like whatever it takes, maybe it's not just putting it all in the stock market on Monday, right? That would take a lot of bravery, and maybe you have it, maybe you don't. But I would say, like, making the habit to just invest in the stock market, in a stock fund, a broad US stock fund, and just having that be what you do from now until you need the money, and just give the market time to do its thing. I mean, that would be what I would encourage. And it's not just young people, it's like anyone who expects to live several more decades, right? Which is not just young people, it's people in their 40s, right? People in their 50s, in their 60s, in their 70s, right? Like, I think if you expect to have more than 10 years left on this earth, knock on wood, right? I think that's what we're hoping for, that you plan for that and you put some money in a time capsule and shoot it off to that point in time because you expect it to be worth at least twice as much as what it's worth now. Those are the things I wish that I understood when I was in my 20s. I did okay. Like, I don't want to say like I, was like stuffing money under my mattress. Like, I still did invest. And that money that I did invest in my 20s, I used when I started my business, right? Which is what I have now. I wouldn't have my business if I hadn't done that in my 20s, right? And taken advantage of it. So that's why, especially like with this group of women, like most of us are going to live a long time, right? Like, hopefully I want, everyone to, live a long time and to have the resources that you need to take care of yourself, to take care of your family, to take care of your community, to take care of whatever you want to take care of. And the way to do that is with more money for most people. It's one of the tools. It's not the only one, but it's a pretty good one to have. But I'll get off my soapbox now and open the virtual room to advice that other people have, because I know you have it. I know all of you out there have advice for Ellie, so I'd like to hear what y'all have to say.
So I can go next.
Great.
So this is the third downturn that I've experienced. When I first graduated college, I had a little bit extra cash, and I had this option of either paying some student loans off, which at the time interest rates were really high on student loans, or put it in the stock market. And I decided to put it in the stock market, and that's when the tech bust happened. And I lost all that money. And as a first-time investor, it really scarred me. And so I actually stayed out of the market for a long time, and then started slowly getting back in several years later, just through a 401k. And then by that time, when the next recession hit in 2008 or 2009, I was like, I am staying in, I am putting more money in. And those are the lessons that I've learned from the crash in 1999 or in 2000. And so this third time around, I've still taken the same lesson. It's just kind of stay in there, because I'll probably live through at least 2 or 3 more of that. So it's even if you were to buy in and it keeps dropping, it'll come back up. So that would be my advice.
I love that, Anna. Thank you for sharing. Who else? I know you got something. Come on, Lori, Dora, Joyce, you're in here. I can see you. Do I need to unmute you?
Okay, I'll go next. This is the second one that I remember. During the 0809, it's really weird. I spent many of my years at the airline. I worked for Southwest Airlines for many years. And I left in 09. And it was a result. I mean, 9/11 happened. And it all kind of happened at that point. But that's when I was like, oh my gosh, where did my 401k money go? And it made me really sad. And I thought, okay, I think I took a step back and I got really more just conservative with my money. I was more careful. I paid more attention. Sarah, you're right. When you're younger, you almost look at your, you put it there, you start your 401k and you don't think about it. And now as you get older, you start to pay more attention to it. And so this is the second time I've seen it do this. So we got the 0809 and now we have this whole thing. But even now, I think now is very different, even from 0809 stuff. So that's where, I mean, a week and a half ago, I was like, oh, it'll be okay. It's not gonna, I'm gonna hang in there. And these last 2 days, I've gotten really concerned. I'm thinking, ooh, I better go look again. And that's only making me more nervous.
Yeah.
It's like you said, looking at it every hour on the hour. You can't do that.
Yeah.
So that's just my little experience.
Do you think, Dora, that it's a function of being closer to retirement? This
Absolutely.
to focus? And it's, that being a date, that's the one that changes most people's perception. And it's like the idea of like, when do you need the money, right? When you do start envisioning a time when you do need some part of what you've saved, right? It does definitely make it more difficult, right? It should be more difficult.
Right. I think staying the course too, because it's like you said, you want to think of 10 years ahead. Hey, was Amazon doing that badly, a month ago? I thought they were doing pretty good.
Yeah.
They're likely to do way better now.
Right.
So it's kind of like those time frames that you look at and you're like, okay, definitely I think it's a because I am closer to getting to, okay, am I inside of 10 years or am I outside of 10 years? I think I'm slightly outside of 10 years. But yeah, we're going to pay more attention. I try not to stress about it.
That's really good. Awesome. Thank you.
Can you hear me?
Yeah. Hey, Joyce.
Oh, okay. Yeah, this is unusual for me because I'm on the phone, and I'm pushing buttons. No, I was actually planning to retire in July, so it's going to be like a gratitude thing. Like luckily I haven't retired yet, and I'm hoping that over the next few months, it's just a sit and wait and watch and kind of go on with life as usual instead of making any big changes. So that's pretty much, I think, advice for in general, like don't panic and just don't make any big changes.
Yeah. That's really good.
I agree. At first, I was thinking, okay, I have to wait this out. And then I immediately thought, okay, how much cash do I have on hand in case I need it? Because I don't want to have to sell anything.
Right.
And then I thought about some advice that you gave, Sarah, about getting a home equity line of credit. So I went to my credit union to find out how much that is. And their interest rates, I think, are around 3.14. I went to Amplify Credit Union. And the fee was $325, which is pretty low if you think about it being closing. I don't know what the payback requirements are, but so that was basically what I was thinking, because I remember you saying before, Sarah, during one of the meetups that while things might be a little rocky right now, credit hasn't closed down yet.
Mhm.
But when it closes down, you won't be able to get those home equity lines of credit. So I've been speculating about whether or not to do that.
Oh my gosh, go do it.
But don't do it or do
Oh,
it?
do it. Yes, do it. It's money. Even if you don't, you might not need it, right? But you have it.
Yeah. It's only if you use it, then you
It's
pay it
only
back.
if you,
Otherwise, it's just waits for you.
right. I would get it. I would.
So
$125?
that's
That's like less than a therapy session, right? It's less than so many things.
I
That's
have
easy.
home equity line of credit.
That's a review. I can make it. I can live to fight another day. I often like the mantras I have in my head during times like this. Like sometimes I'll just be like, just keep swimming, just keep swimming. Was that from Finding Nemo?
Yeah, it was Finding Nemo.
Finding Dory?
Yeah, we can tell
and
you
you know,
have
like,
kids.
what do you have to do to like live to fight another day, right? Like how how much can you take? How long can you hang in there? What other things can you look at and micromanage? Or your stock portfolio, right? There's lots of other things to work on. Home equity lines of credit, yeah, like maybe trimming your budget, tightening things up a little bit. There's lots of ways that you can spend your financial energy other than like secretly logging into your brokerage account and selling all of your stocks because you're freaking out. So we don't sell at a loss. We don't sell at losses here.
No, so we don't sell.
We do whatever it takes to live to fight another day.
And I also play a little game. How low can you go? How much money am I going to lose? Will I actually get to 50% loss? Wow.
Oh, yikes. Yes.
So it's a scary game, but
It is a scary
at least
game.
it makes it a little bit more fun.
Yeah, it sure is.
Anna was asking about international stock, and I think basically, I don't think you'll have any advantage to buy it. I think it's going to hit globally, but I don't know what your opinion would be, Sarah.
Yeah, so the question, can you talk about international stocks, mutual funds? If a recession hits, would adding it to a portfolio balance the risk with domestic stocks? Or a recession's usually global? I know you just said that, Lori, but I was just reading it to myself. Okay, so let me back up. So when you are doing all of the educational requirements to become a financial advisor, the first thing you learn is diversification, right? Don't put all of your eggs in one basket. Make sure that you have some money in US stocks, have some money in international stocks, have some money in bonds, have some money in international bonds. Because, typically, like if the US is doing poorly, then maybe the rest of the world is doing okay and vice versa. And so that's like the standard line. And there's probably evidence to support that in some way. I personally, because of some other numbers, don't subscribe to that as much as my peers do. I found one of the things that really concerns me about an economy in general is demographics. So the way you calculate economic growth is a function of two things. It's the change in population plus change in productivity. So population growth plus productivity growth, like the more stuff that one person can do, right? Those two things together drive economic growth. To a certain extent, right? You can't have like super crazy, super high population growth, or otherwise it goes in the opposite direction. But like if we're talking about kind of normal rates of growth, and there are only certain economies in the world that have positive population growth. I know that I talked to Lori about this in the past, but there's many economies are faced with declining populations, right? Japan being the most famous one. They've been in it for a long time. China being one that people kind of forget, like the one-child policy is now meaning they're starting to come over like the working age population hump. So if you have fewer and fewer people working, you have fewer and fewer people participating in the economy, it can be a drag on economic growth. And in the US, we still have positive demographic growth. And we also are fairly unique in the world in that we can import people. Like we're we've historically been a nation that welcomes immigrants, and we can continue to do that. And there are a lot of populations in Europe that are also in declining populations. So it's not like find the populations that are growing and that will lead you to economic prosperity, but I think it's a very serious economic headwind to have declining population growth. So for that reason, in the international stocks mutual funds, I would be very, very selective about what parts of the world you are overly exposed to, and maybe what industries you're exposed to. So for example, I tend to prefer, if I'm in the international market, I'm focused on international technology, because technology has its own exponential growth and it's not necessarily bound by borders. But not just like not necessarily a very large allocation to just a generic international stock market ETF or mutual fund, for the reasons that I said. That was a long answer to a short question, but I think it's important now. I think that Europe coming out of this is going to have a harder time than we are for those reasons. And it's something that you can't change demographics, right? Like it's very, very difficult to change demographics. It's you either get women to have more children, which not super great from a policy perspective, or you have to open your doors to immigrants. And there's some countries that are not willing to do that. And there are times when even our country is not willing to do that, but we still can. So I think it's still a positive.
Yeah, that's actually really interesting, because as I was saying earlier, back in 1999 when the tech market crashed, I noticed like the U.S. stocks and mutual funds, that the index fell quite a bit, but the international ones went up.
Mm-hmm.
So there was that, that opposite effect. And so I kind of took that lesson and thought that might be something to help balance that risk. But again, with this coronavirus, it seems a lot more global, and that's why I asked that question, to see if
yeah. I mean, it's a really, really good question. And if you looked at demographics that many years ago, they would have been different, right?
Right.
Back then, people were talking about overpopulation, right? And like, when did China institute its one-child policy, right? But once demographics are in motion, it's predictable, right? Like you can forecast demographics pretty easily because everybody keeps track of births and deaths. And so like it might have been it certainly was a different demographic trend back then than it is now. Now, I think people have been seeing this declining population trend for however many years, but it's really easy to forget about, right? Like what happens when you have more people not working than you have working? Right, I taught these classes on the stock market to visiting scholars from China, right? So basically like college kids from China. And they would come up after the class and they would talk about this phenomenon of very few of them had a sibling. So there was one child, and it was on them to take care of, they would get married, and it was on the backs of those two people to take care of four people, right? Take care of their parents. And in addition to if they had a child or children of their own. So they were very much feeling this economic pressure, right? How am I going to take care of 6 people maybe, plus ourselves? I mean, if you think about it in that way, and a lot of people in the US are dealing with that too, like the sandwich generation, right? Like I'm taking care of people, all over the place. It's really, really difficult. But the US doesn't have it in the same way that a lot of other countries do. So I think you have to be really careful just to say like, oh, international, it'll go up when the US goes down. I think they might, because we're global, it's more synchronized. You might get a little bit of offsetting effect, but I'm not sure if that is as powerful today as it was in the past. That might be something that's changing. Or you might be more selective about places that are relatively capitalistic, like, and can incentivize this growth and have population growth. So like India is one that comes up all the time, right? Like relatively good demographic growth, and they're relatively friendly to business. So it's kind of things like that, but but it's interesting. It's an interesting question. And that's just, it's my opinion. I mean, I do an awful lot of reading on this, so I feel I'm pretty strong in my convictions, but I know other people have different opinions on it.
Thank you. Yeah, like I said, my financial advisor, he's probably part of that old school thinking to add into that mix of the allocation.
Yeah. And it might be okay to have it be some. I mean, I think, even at Vanguard, I think they recommend something like a 35% allocation to international markets. I think that's too much. But who am I to argue with Vanguard, right? So you just kind of take it for what it's worth. But especially in those target date funds, like if you, if you kind of maybe, give weight to what I just said, you might want to check those target date funds and see if they're in line with what you want your asset allocation to be.
Cool, thanks. That's really interesting.
Yeah. Thanks, good question.
Sarah, Peggy has something she wants to say.
Oh, hey, I had a question earlier. Somebody else was talking a little bit ago about retirement stuff, and I've been kind of in the midst of a mind shift, and I'm kind of curious what you think about this. But I think historically we've always thought when we retire that we want to not be investing, but we live longer. So what are your thoughts on that? Like when to shift all the kind of what we have, the allocations and things like that as people are nearing retirement, because you might need another 30 years or something. So
Yeah.
it gives you time to bounce back from what's going on currently.
I have a really strong opinion on that. I think I kind of alluded to this before, but just to be perfectly clear, if you are retiring in your 60s and you expect to be paying bills into your 90s, you're going to need more money, right? Because the bills that you're paying for in your 80s and 90s are probably going to be things like health expenses, which tend to increase faster than the rate of inflation. And even if they're not, I think most people going through retirement, like if you think back, like I think we probably all had this experience where you see the elderly woman in the grocery store, right, with like the coupons, and and someone's on a fixed income, right? Like, okay, I need to be really careful about my spending because I'm on a fixed income. Fixed income is a pension, right, where the monthly payments that you get don't change. Social Security is a pension where the monthly payments that you get change very little from year to year. Or the bonds. Bonds are fixed income. It's called the fixed income market. So by being in only those conservative things, your purchasing power is being eroded every year, death by 1,000 cuts. And by the time you get to the point where this is becoming a very serious problem, you don't have any time to have any money in the stock market, right? Are you going to be 85 trying to play the market in order to have more money when you're 90? That's crazy, right? But when you're 65 and you imagine being 95, now you have some portion of your portfolio, and probably not 100%, right? 50%, 60%, 40%, whatever the number is, some portion is for your 95-year-old self to come back for. And you give that portion a chance to grow instead of having it all be in cash or all be in bonds. It is not going to keep pace with inflation. Or if it does, it's going to be barely keeping pace, and you're going to be losing purchasing power every year. So that is something I should feel really, really strongly about, is that there's this transitional time where you might take more risk off the table while you're going through the 5 years before retirement or the 5 years after retirement, something like that. But it's not going 100% cash or 100% bonds. There's some portion that's set aside and invested for the long run. And that can be really difficult for conservative people in retirement to go through times like this. But the conversation I've had several times over the last few weeks is, you are still young. You have this, you have this money in cash that you set aside. You have this money in bonds in your portfolio. And then you have this relatively small portion in stocks. Even though that portion is bouncing around a lot, it's not for today. It's for 10 years, 20 years, 30 years from now. So that's what the stock market is for, so that when you come back for that in 20 years, when you're 80, then you'll have more money than you would have otherwise. So again, I kind of went a little soapboxy there for a while. I apologize for that, but I actually feel pretty strong about that.
Thank you.
So we have about 10 more minutes left on our call. And Ellie was wondering if we can do some more brainstorming, if not on things where we might want to put our money, but things we might want to avoid, like cruises, music industry, or Corona beer.
I have one. I think that's a great idea. I also know that Shannon is on the line and she has a question to ask too, that maybe we can end on the brainstorm, but because I love that idea.
Sounds great.
Even if we kind of stick around and people want to kind of slowly drop off the call, maybe we can end on that one. But is there anything else that anyone wanted to add or ask?
I think I just want to add stuff, if I may. Can you guys hear me?
Yes.
Yes. Hi. Yes, my name is Alexandra. I love these meetings, and, I hear people where, looking at the stock market and what it has been doing, and a lot of people get worried about it. And I think it's regardless of what age we are, me personally, I get more energized, I think, because I see it more as an opportunity to invest, to go heavy on stocks and learn more about everything that goes on. You kind of learn about the history, what happened, in 2008, 2009, during, 98, between 98 and 2000. And just, I feel I'm loving to get more involved into investing and learn more about stocks and the bonds. And I'm definitely not dealing with CDs because I rather stuck my money under my pillow in my mattress. But instead of doing that, I gonna throw it on the stock market. So I guess I want to encourage people rather than looking at it pessimistically and negatively of what's happening. Look at it more of as an opportunity. And that's my soapbox. Thank you.
I love that. Thank you. Awesome.
Okay, I'll go. This is Shannon.
Hey, Shannon.
Can you hear? Yeah, you can hear me. Okay.
You're on. You're on the party line.
Wonderful. So yeah, I would like to say too that I do enjoy going to these meetings and listening because it does give kind of some sort of hope for the future. I happen to be like a person who invests in like my current 401k, and I just kind of don't look at it and kind of let my work do that. So my question was, this is a strange time to be. For me anyways, is it happens to be like I'm still in student loan debt, and I've got this kind of plan of an idea of when that is going to be cleared, which would be in fall 2020. Now, it just so happens that we are in this kind of time where it may be good to take some of that money that was going to go towards the loan pay off and maybe kind of dip a little bit in the stock market. So a part of me is like, Shannon, just stay the course, don't do it. But then here's the thing, we got our bonus checks yesterday, and I'm like, oh gosh, what do? Do you take the bonus check and you like put that money towards your loan? Or at this particular time in your life, do you perhaps take some of that money and like put it in something and then make up the money? It's not, this bonus check is not going to make or break me paying my loan off any sooner. It just happens to be this particular time in my life. So that's my question. And I know you can't give advice, and I kind of feel like I have the answer already, but that was my question.
That's a really good one. Does anyone else have opinion on the loan payoff versus the stock market at this point in time, with the stock market being what it is?
Yes.
I guess the big question would be, is the interest rate low? If it's low, then let it ride.
That is a good question. Shannon, what's the interest rate?
I'm at 3.8.
Ooh, that sounds low.
Real low.
I would sink it into the market. That's what I would do.
Oh, I wish I could work the polls. I could take a poll for you, Shannon, and it could be like, what did Shannon do with her bonus check?
I would probably put it in the market too, but I tend to be kind of aggressive with that stuff, so it depends on how soon you're going to need the money, I guess. In the long run. I mean, I know your loan, but do you have when Sarah was talking about the 20-year future, you know, that's what you'd be investing in, is the long term rather than the short term. Yeah.
Yeah, I mean, that's kind of, I'm thinking just like right now, I'm thinking opportunities presenting itself where if I deviate from that plan, you know, for one paycheck, is that really going to put me back that far? And then another part, like I feel like I got Dave Ramsey on my shoulder saying, "Don't do it, just pay off the loan."
Jeez.
Dave Ramsey on one shoulder and the Austin Women's Investing Group on the other shoulder.
Well, I think overall with the numbers, as you said in the last meeting, Sarah, where overall, you know, the stock market could be, you know, 8% or up to 10% over the long haul. So putting your money in a market and you end up with that 40 years down the road versus student loans, which is only at 3.8%, plus you get to write them off taxes, plus there's some Democratic presidential chatter nominees saying they want to do some loan forgiveness. I mean, there's a lot of advantage to putting it in the market at this point.
Wait, isn't that on the table with the new stimulus package or whatever that got announced on Friday? Isn't not having to pay student loan interest? Was that part of it?
Yeah, I don't know about that. I mean, I'm not buying
I know it's just a proposal.
To the politics stuff. I really,
Yeah.
I mean,
Let's not rely on that. Yeah.
Yeah, but see, I wouldn't be on that plan anyway, though. That's the thing, and even like if you pay more, which I'm doing with my student loans, it's really not. You do not get a great tax cut from it because I'm paying more than than what my monthly payment is. So where you think you're going to get a great tax break because you're paying off your student loan, I'm actually filing taxes this weekend. It's not that much. And I paid a lot in 2019.
Yeah. I mean, I think kind of what you said about like, okay, you have this bonus check. If you put the bonus check to the loan payoff, it wouldn't really change the plan that you already have in place anyway. But I do think that, you know, even a little bit amount of money, let's say it's $1,000, and I know you're 40 because we're the same age, right? So if you can turn that $1,000 into 2,000, then 4,000, maybe in 20 years, like double it and then double it again, that seems like a really big impact on a decision you can make today. Like, do you save a month of, you know, do you pay off your student loans a month early? Or do you have the potential to turn your $1,000 into $4,000? I mean, it's still 20 years, right? So it's not going to happen overnight. But it seems like at least with the bonus check, that would be an interesting thing to think about.
Okay, I'll continue thinking about it.
Sorry.
Because it just happened yesterday.
Yeah. Oh, one more question for you, Shannon.
Yeah.
If you put I'm just making up the amount of your bonus check now. Like, let's say you put the bonus check in the stock market and the market fell by another 20 points. Would you be really mad at me and us?
Wait, ask me that one more time. Say that again.
If you put the money in the stock market and the market fell by 20% from here, would you be really mad and sad at us and me?
To be honest,
Yeah, that's
no,
just how it
because
goes.
I would pretend like it's not like you just for me it's like you pretend like you don't have the money. Like that's kind of like out of sight, out of mind. Kind of
Yeah.
that's how I look at it anyways. And that each time that I do get paid and I pay that paycheck, it's like I pay that loan, I'm like out of sight, out of mind kind of thing.
Yeah.
Eventually I will come to the point where I will be able to look at that number go up. But right now it's just like out of sight, out of mind. It comes in and goes out, comes in and goes out.
Yeah. Good.
So if it fails, I just when I don't there's a part of me I don't even think I'd look at it.
Yeah. That's good. Well, I love the idea of ending on things that people are trying to avoid in the stock market right now. What are just things that you are like, nope, this is a terrible idea going forward? Or are you asking me? I think I already talked about Boeing. So maybe it'll be fine, maybe not. And airlines are freaking me out, and definitely cruise lines, because I feel like with cruise lines, it's going to take a long time for people to not think of cruise lines as like a walking, like germ pool, right? Or I guess a floating, like just a floating pool of germs. And
Incubator.
Incubator, yes. I think that's going to be really, really tough for that industry specifically to get over. It's going to take like a very serious PR campaign at this point.
I think airlines are going to have a hard time. I just think they're going to have a hard time.
I think in the short term, I think you're definitely right. It's funny, like before this, like the trend, it was more people flying. As people get wealthier and different parts of the world, more flying, more miles being traveled. So I wonder like how long, like kind of that overall trend, which is taking a long time playing out, like how does it get disrupted in the short term with these companies that have a lot of debt and a lot of real problems in the short term? Maybe it does turn into like a government bailout of some sort to at least keep them surviving, but that doesn't mean it's a good investment, right? And we have Disney on there. That's so interesting. I've heard on Disney a couple, like there's like on one hand, there's the theme parks, right? But on the other hand, there's Disney Plus streaming, right? So while people aren't going to the theme parks, are they just sitting at home watching Disney streaming? Is that enough to offset it? I don't know. That's a tough one. Yeah, LaQuisha says Carnival Cruise Line. Nope. The travel industry, yeah, it's just going to be super tough. Oh yeah, LaQuisha says Disney will do good with all the kids at home watching Disney Plus. Anna says retailers that are already struggling, like JCPenney, H&M. Yeah, retailers were already in a very bad way. That's going to be tough. One of the retailers that's been doing well and came out of the financial crisis pretty strong is, oh my gosh, Ross and TJ Maxx. I think they're actually the same company now. So that's some retailers maybe will figure out how to get through this, but other ones, I think this might be the end of it. Oh, Dora says movie theaters, and I love going to movie theaters. Yeah, that's going to be tough. Again, like that idea of like, where do people congregate? Very, very interesting. Anything else that people, I like the Corona beer one. Corona beer is owned by Constellation Brands, ticker symbol STZ. That's funny. I actually don't think that STZ has been down. I don't know if it's necessarily because people equate coronavirus with Corona beer. I think it actually might be that they have a sizable investment in this Canadian pot stock, and pot's been a tough industry over the last year or two, but good things to think about. All right, well, it's 4:33, y'all. I know we started late, so I'm definitely willing to stay late if anyone has any additional questions. But before we do that, just if people have to end up jumping off, thank you for hanging with me on our first web call. I'm so excited we were able to have it. Thank you, Lori, for coming and helping.
Yeah.
Me. Thank you
Virtual high five.
Virtual.
Group high five. This is how we will touch in the future.
That's amazing. Now we know how to do it. We can do it, you know, and I just appreciate everybody's support and patience and the willingness to jump on this call, because I think it was really important, and I think it made me feel better about this week to listen to all of you smart women talk about the things that are on your mind and share your questions in your comments. So I really, really thank you for that. I needed that at the end of a long week, which is why I was just like, I'm scheduling it. I don't know what I'm doing, but I'm going to schedule it. So
Sarah,
thank you.
oh, sorry, Sarah, do you think we'll do this in April too, or do you think we'll meet together?
No idea. No idea. It's definitely possible that we would do it again in April. We do have a room booked. Leaving it totally we'll just see what happens. I hope we get to see each other in April, right? Like, let's all like do the best we can to flatten the curve and, you know, kind of make everything manageable through this. And hopefully we get to see each other in April. Though now I feel really good that we at least have an alternative if it doesn't make sense to do that. Cool, great. All right, I recorded this whole thing, so you can listen back to yourself or send it to your friends. I don't know, I suppose now I have to figure out what to do with the recording and where it goes and how to get it to you all. But I know that other people in the group who weren't able to join us are gonna be really excited that we were able to record it. So I'll try to figure out how to get that posted, send a follow-up email, and hopefully be able to see you all in person in April for it's a meeting on Medicare, which is really, really interesting. If you're getting close to or know anyone getting close to that age 65 when you file for Medicare and you start getting all of your options dealt with, it'll be a really good, constructive, but not stock market related meeting. So I think it should be really, really good. All right, let me know what pops up. Thank you, everybody.
Thanks. Bye.
Thanks,
Bye-bye.
Thank you.
Talk to you later. Bye-bye.
Thank you.
Thanks. Bye.
Bye.